Welcome to another episode of Selling Southbay. My name is Aaron Alcides with Alpha Real Estate Group at Keller Williams. And today, I am here with a great gentleman. He is, hi John.
John Servatius.
John Servatius. Did I say it right?
You did. You said it perfect.
It's been such a challenge. I was practicing. John, thank you. I really appreciate you allowing us to come and interrupt you. I know you guys are pretty busy. You just went through a deadline and you have another one coming up in October.
Well, there's one tomorrow, and then there's one on the 15th of October, which actually is the 17th.
Oh, okay.
It's the federal calendar. It's not quite the same as everybody else's calendar.
Well, I truly appreciate then you making the time for us.
My pleasure.
We promise to be quick, and it's going to be easy. You're not going to get any tough questions unless you want them. But tell us a little bit about you. Tell us about how long you've been doing your job, and why, and how did you get to who influenced you?
Well, that's a big question. So back when I was in high school, I figured out my dad was an accountant, and I was good at math, and so I just continued excelling in math, and I ended up at college, decided accounting would be the focus. We were back in Syracuse, New York at the time, and after the freshman year back there, moved to Fresno, went to Fresno State. I don't know if you know it, but Fresno's hot. And I did the equivalent of a 4-year program in 3 years, because although all my units transferred, they didn't match the program.
Oh, okay.
So I had to do 124 units there. So I actually got over 150 units of college to get my 4-year degree. But I got it. I moved down to the Southbay here in Manhattan Beach. One of our partners here, Ross O'Brien, was my first roommate here in Southern California. And I couldn't get into the CPA firms in LA from Fresno. So I started with the state of Texas, located in Culver City. And I did tax audits for companies.
Okay.
And I did that for almost 2 years. Then I got into a big 8 firm at the time is what they were called. It's down to the final 4. And from there I went to a slightly smaller firm and then a slightly smaller firm. And when I say smaller, they're still $500 million or larger in revenue. And then in 2012, Ross and I decided enough of that. And we formed our own firm, Servatius and O'Brien. And then we met Marietta Fong, and we combined forces 7 years ago and became Servatius, O'Brien, and Fong.
I was actually just thinking about that. I've been to, I know Marietta for quite some time. I think we go back to 2003, something like that.
She's a major player in the South Bay.
Yes, very involved. I think she was the chairwoman for the chamber.
Yep.
When I met her. And, you hang out with the right people. I actually was the chairman of the board for the chamber in, I think, 2012. But what a wonderful lady. And I guess I've been following you guys because I've been to 3 of your grand openings. When you were in the Sky, I think at one point they were on Sky Park, then moved up to, where was it, Maple?
Columbia,
right there, Columbia Maple.
Yeah.
I like that location because there was a brewing company, right?
There's actually 2 of them.
Oh, 2 of them. See?
Yeah.
I only knew about 1.
And there was at least one other accounting firm in there. And they had formed 2006 from a couple of the partners came from the firm I was with at that time.
Yeah.
So small community.
Yeah. How long have you been on this location now?
So we moved in here in January of 2017.
Okay.
And Marietta's firm, Fong and Associates, had been at Sky Park and then moved over to Columbia, and that's when we met her. And so we moved in with her. And then the owners wanted to sell the building, and we didn't want to buy a building, so we negotiated with the folks here and got this space, and it was an empty floor. They were just in the midst of constructing everything, so we got it built the way we wanted.
Well, you have a beautiful office.
Well, thank you.
I got to say that.
Appreciate that.
So tell me a little bit more. Is there a specialty that you do, or is it just general?
So in the world of public accounting, there's a couple camps. There's the audit camp, also known as assurance, and then there's the tax camp, and then there's the consultant camp. And I grew up as a tax person. Never really wanted to be an auditor, but back then you had to be an auditor, or you had to get some hours in order to become a CPA. So I did the amount that was necessary. I got certified.
Pay the dues.
Paid the dues. And every 2 years they make you pay again. But got that license and continued on. I got my master's in taxation from USC. And that was when I was with the first big firm, the Big Four firm. And that helped me a lot. I love to say, in an interview situation with recruits in the past that came from UCLA, do you know what USC stands for? Now, if you're a UCLA person, you know it stands for University of Spoiled Children.
Right.
But as an interviewer, I turned it into University of Second Chance.
A second chance.
And I only brought that up with the people I was interviewing that were getting their masters, but had gone to undergrad at UCLA. And I would say, well, you went to UCLA, you couldn't get a job. So now you're over here to get your master's so you can get a job and get the network. And it's a great academic institution at UCLA, but I don't like the football team.
I don't
So
know.
that's my animosity towards UCLA.
There's a little rivalry between those organizations, I think.
Just a little
It's
bit.
tiny.
And now they're both going into the Big Ten. So
Well, hey.
So I've had some conflicts in football. Being a Syracuse native, a USC alum, and a Fresno alum. USC just played Fresno a couple weeks ago, and that was a conflict. Who do I root for? When Syracuse played USC, they had back-to-back years. I couldn't watch the games.
Yeah.
Everybody scored a touchdown and gave up a touchdown at the same moment, and it was torture. So I just turned it off. So, but I like football. So.
Well, there you go. I don't know. I would just, in that case, I would go with the winner. No, probably not.
I think where I grew up has a little more pull. My great uncle was a quarterback there and a coach, and to this day at Syracuse University, he's got the highest winning percentage of any football coach. And he coached back in the 19 teens.
Wow.
So it goes back a few years.
All right.
I didn't mean to turn this into a football discussion.
Well, no, and I'm telling you, you're talking to somebody that doesn't know a lot about sports. And I'm active. What I like to do is I like to play every sport, but for some reason I never got into the habit of watching it. But let's go back to the CPA stuff.
Okay.
Okay. So, what's your let's say for your firm? What's the ideal client for you guys?
So that's a question that's perplexed every person that's ever asked of in every field. Because the ideal client is somebody that needs your services, values your services, generally takes your advice, because I always think of it as I'm paid to come up with solutions and possibilities, but they're the ones that have to make the decisions and live with them. So sometimes my advice is taken, and it may not work out perfect because of something the IRS does. Other times it's not taken, it would have worked out perfect. Most times the advice is taken. So the ideal client is somebody that just values the relationship and enjoys coming to their professionals, particularly the accountants, because that's what I am, before they do something.
Right.
So we can help them. Having said that, there's been a lot of clients that I've extricated them out of problems after the fact. I've done some really creative tax planning in the throes of August and September, getting the extended due dates for the companies filed,
Mm-hmm.
and they never told us about the transaction, or we got a new client, they'd already done something. And so we prefer to do it up front, but we can do it towards the deadline as well. And so the ideal client is somebody that just values the services of a professional. And we have clients right now that are upwards of $100 million in revenue on the business side. And we've got, not going to tell any names, but I do have a 90-year-old little French lady that she's got accounts over in France and accounts here, which makes her a little bit complex to report. But she just wants a friend. She wants to talk to somebody that'll listen. And I just sit there and listen. So I become more of a therapist than a tax guy. But I make sure her taxes are done.
Right, right.
And so I value every one of the clients from those two extremes, because if they value my relationship with them, I want to value their relationship with me.
Absolutely.
Probably no different than you and your business.
Well, and relationships is what makes our businesses, in a way, be consistent. The one thing that I want to point out is that you mentioned there that the people that actually take on your advice is like preventing accounting, like preventing medicine. When the doctor tells you exactly what you should be doing to be okay, but it's your choice if you execute or not.
Correct.
So that is super important. And but I want to know your opinion about when should people make the switch between a simple tax preparer, let's say, and a CPA?
Okay, that's a great question. So if we're going to talk about individuals for this, an individual that has a W-2 and owns a home, so they got property taxes, they got a mortgage probably, they might give some to charity, and that's what they have. They may have a couple kids. That is a good candidate for the H&R Blocks of the world to do their work.
Yeah.
There's not a lot of sophistication. There's not a lot of planning that we can do. I can advise, are you maxing out the contributions to a 401k?
Right.
Are you putting some money into an IRA or to a 529 plan for the kids' education? But that's about all I can do. When you start getting into some other things, such as owning real estate, rental real estate,
Right.
then we can start helping to plan that. We can work with the rules for writing off improvements to the property and the best way to do that, whether you're going to get some solar credits. There's a lot of things we can start doing at that point when you start having more than just a W-2.
Or just a depreciation on property. I mean, a lot of, I find, at least my experience has been talking to my clients, is that a lot of just tax preparers don't quite understand those basics.
Well, and one of the reasons for that, you probably wouldn't know this, is that the IRS likes to make rules.
And change them all the time.
And change them. And the rules on depreciation are probably about this thick. And when they change them, they don't make them simpler. They leave everything in place. Then they layer on some more complexity. And so it's tough to maintain it. But in 2017, the changes they did then changed some of our thinking, and the way that we're working with our clients on depreciation, for example, is that normally you'd say write everything off when you can.
Right.
And they made it very liberal. You can write off 100% of everything except the actual building and some of the tenant improvements and that and some of the land improvements. But writing everything off in a year sounds great, but there's a planning aspect too, because if you're an individual, writing it all off might take you down to zero tax, but maybe it's better to be at 10 or 12% tax rate and claim some of that next year when you're making more money.
Right.
Because the deduction is only worth the tax you save.
True.
And so there is some planning there. And on the corporate side, the business side, doing all that in a certain manner, it's called Section 179 for the geeks. The 179 deductions are treated as a deduction in the year that you are able to use it. Okay. So I may claim it in 2021, but I can't use it. So it carries over to 2022 and becomes a deduction of 2022. And corporations have a special rule that they have a minimum amount they have to pay tax on if they bring forward a loss. But a Section 179 deduction is treated as if it occurred in the 2022 year. So there's still some planning there,
Right.
And it's ever evolving. And like I said, they never make it simpler.
So, and actually, your explanation made my point in a sense that when it gets that complex, is when you definitely need the services of a CPA.
Yes.
Why? Because you could be leaving a lot on the table or taking chances on what you're claiming, and that is one little path that you not want to go through or walk.
Another one that's out there that not everybody thinks about is, let's say you sell somebody some investment real estate. It's not going to be rented, but every year you got to pay property taxes on it, and you got to pay, if you take out a mortgage on it, you got to pay
Right.
the expense, the interest expense. There is a way to take those expenses and push them into the basis of the property as if you're adding to the cost, so that when you do sell it, you get a full benefit for those deductions down the road. Or if you convert it to rental property, you have a higher amount to then start claiming depreciation. Some people don't think about that, and they get these deductions, but they can't use them.
Would that also affect the value at the 1031 exchange or doing an exchange?
So that's a really complicated area that they tried to make simpler. One of the few times they tried. 1031 used to be even for cars. You take your car to a dealership, you trade your car in, they say, we'll give you $5,000, here's your car for $30,000, give me 25 cash.
I did not know that.
That was a 1031.
Oh,
In
interesting.
2017, they said, no, 1031 is only for real property, buildings, land, that's it. So if you have an investment piece of property and you start adding these costs every year to it with that election, that increases your tax basis, so the deferred gain when you do the transaction is less.
Okay.
And if you're a California resident, which probably most of the people watching this are, California never wants to give up $1 of tax to anybody. And so some of our clients will do a 1031 exchange for property located in California. Then they buy replacement property in Oklahoma, New Mexico. Well, until you sell that property that you just bought, California makes you keep filing that deferral of gain, because when the property that you replaced it with is finally sold, they want their tax dollars.
So it stays with you.
it stays until you get rid of the property.
Right.
As individuals, when you retire from California and leave the state, they wanted to tax your pensions that you earned here, but
Yeah.
they couldn't. So that one they took their claws away from. But when it's the 1031 exchange deferred gains, that they keep their hooks into until they can get their tax.
You know, and I have heard of that because a couple of clients of mine had decided to retire in Vegas, and you know the
Popular place.
yes. So they were a little concerned about that, about the California still having their hands on their pensions.
And you actually bring up an interesting thing that we've done a lot of planning with is people, unfortunately, trying to leave California.
Really?
It's been happening lately. I don't know why, but California, believe it or not, has rules that they follow, guidelines for, are you a California resident or not? And I just had my first experience of the address on a brokerage account and California trying to say the person's a resident of California.
Huh.
But this client, the woman is in Peru, has been there for over 20 years. She's a U.S. citizen, but she's never lived here. But she uses her son as her financial advisor and used his address for the paperwork.
Oh boy.
And so now we have to respond to this because California, like I said, they keep trying to get people in the system.
Right. Right.
And so we're going to report it back and say, no, she's not taxable. Nice try.
And once you're in that system, boy, you better
They
get
don't
it
like to
clear.
give
Yeah,
up.
you better get it clear.
Yeah.
Well, as you can see, and this is one of the main reasons why I like to have these chats with different professionals, because there's so much. I mean, the tax law can be so complicated, but at the same time, there's so much in there that can benefit somebody that is not a simple tax. But somebody that starts getting a little sophisticated with corporations or businesses or investments in real estate, then my recommendation is definitely go to a professional so you can get the most out of it. Well, John,
By the way, I may be biased, but if you're going to go to a professional, we prefer it to be us.
there you go.
And if you need somebody to help you purchase or sell, Aaron's here for that.
Perfect. We're going to put your information so people can actually contact you directly, and you do provide consultations, right?
Yes.
Okay.
Ross and I and Marietta have a policy that's been around for years. First meetings, we don't charge.
Excellent.
You got to get to know somebody, and you're talking about a relationship. You're not talking about buying a bag of chips.
Perfect.
So
I actually work with a lot of 1031s, and if they don't have a CPA or they haven't gotten the advice of a CPA before going through the process, I always say, I can't tell you what to do. Please go speak to your CPA. I can find you. I can sell you property. I can find you a new property. But when it has to do with taxes, I stay away from it.
and Section 1031 is one of the more demanding sections because of its tight deadlines and strict deadlines.
Right.
There's other parts of the code where you can use an estimate. You can say, I'm sorry. Can I get it now? This one is, you got 45 days or you got 180 days. And if you miss that, you're out.
You're done. Yeah.
Uncle Sam and I guess Uncle Newsom, they want their tax dollars. So.
Perfect. All right. Well, once again, I truly appreciate you. Thank you so much, John. And if anybody out there would like to be featured on this blog, please give us a call, and we can definitely come to you and make this happen. Once again, Aaron Alcides from Alpha Real Estate Group at Keller Williams. See you in the next episode.